Welcome to our podcast, It's About Payroll. We're your hosts, Brian Escobar and Walter William Duncan III. Whether you're new to the payroll game or a seasoned veteran, we have something for you. Welcome back, folks, as we continue our journey of this payroll stub, this pay stub, trying to understand your paycheck when you look at it. If you've missed a few episodes, we've done an overview. We've talked about earnings with Gerard Hall. So you're missing some nuggets. Catch up. It's season 3. This episode, Walt, won't you let us know what we're going to cover in this episode?
So, we wanted to break down the pay stub like in order, right? So we're going to start on the next section is going to be deductions. And we broke down deductions into 4 parts. Part 1 being involuntary and voluntary deductions. So we're going to discuss the differences between those, some things that you should know as an employee, and just different processes that, you as an employee can practice when it comes to these type of deductions, okay?
All right, cool. Keep it going. Give us a quick definition of what involuntary versus voluntary deductions mean.
Okay, so involuntary deductions are those deductions that are basically made to satisfy like federal taxes, child support, creditor garnishments, meaning like if you have a loan or something that was defaulted or something like that, then they can garnish your wages, bankruptcy, those type of things.
So forced, right? Because involuntary, for those of you, right, who wants to need some quick definition, involuntary meaning you did not choose this, right? You are being forced. This is a mandate. A mandate. Another good word is mandatory deductions. All right, cool.
One of my previous managers said something. I'm not saying it verbatim, but she said with involuntary deductions, like you signed something, but and then in the fine print there was the stuff that allowed them to come after your garnishments. So you already signed something that acknowledged that. So when it comes to involuntary, they're going to go ahead. All they have to do is go to the court because the state allows them to. So you don't have to. The employee doesn't necessarily have to sign allowing the company to do it. They've already signed a contract with that company, basically.
Because like creditors, when you get your credit card, you're agreeing in that million-page document that if you default, they have the right to come and take it back from your check. And I hesitate because it makes me think of the sidebar here. It's relevant, but may not be this episode. When on the rare occasions there's a payroll error, we actually need employees to sign a document saying, hey, it's okay to take this back from my check. The reason why we do that as a best practice is because some states require the document to be signed. Other states don't. But as a best practice, we get it signed regardless of what state you're in. So that's just a sidebar for a payroll professional.
Better be safe and everything, And so good nugget there.
And then what are some examples of the voluntary deductions?
So voluntary deductions are basically something that the employee has signed or elected. So like, for example, the choice, like those benefit enrollment periods, those are elected deductions that an employee selects or picks when they get hired on. And basically, so it's those things that the employee wanted. Hey, we
want it. Exactly. And another sidebar, it is open enrollment season. So folks, open enrollment season is sometimes you get a postcard. I know I see like postcards come through in my house. Hey, your open enrollment is coming in a few weeks. So guys, go look at your mail, because what happens is you got an email? Okay.
Yeah.
What happens is come January, come December, you're going to be like, oh, wait, I didn't re-elect medical. Or depending on how your company runs open enrollment.
Hey, I'm Katie Van Horn.
And I'm Jackie Clayton.
We're your hosts of the Inclusive AMP podcast, where we take on DEI, leadership, and HR without all the corporate fluff.
That's right. We've got decades of experience, a lot of opinions, and zero tolerance for performative anything.
Every week, we dig into what it really takes to build inclusive workplaces with honesty, strategy, and a few side eyes.
We'll talk about the tough stuff, power dynamics, privilege, what's broken in the system, and how we can all do better.
And don't worry, it's not all heavy. We bring receipts, laughs, and real talk from people actually doing the work.
Think of it as your weekly dose of truth, tips, and a little tea to help you lead with intention and show up for your people.
So if you're ready to push past the buzzwords and get into the actual work of inclusion,
You're in the right place. So subscribe to the Inclusive AF podcast.
New episodes drop every week.
Catch us on Spotify, Apple, or wherever you get your podcasts.
We'll be here breaking it down one inclusive convo at a time.
It could be active or passive. And come January, if it's active, you may not have any deductions come out. And you can be like, whoa, where's my medical, dental, vision? Those things are important. But you missed open enrollment and you didn't read the note that said if you don't go actively pick it, we're going to drop everything.
So can you explain to the employee what active or passive is?
Absolutely. And it is relevant because we are talking about voluntary deductions, and this is really where it's born from. This is how you pick your voluntary deductions. Active open enrollment means that it requires the employee's participation. It requires the employee's choices and clicking, and sometimes you don't even have to. Sometimes you just verify the same things, but the company wants you to actively go in, choose these items, and click submit to reconfirm for the upcoming year. And in an open enrollment, folks, benefits and payroll run on a calendar year only. Even if your company runs on different fiscal years, which is challenging sometimes because your fiscal year may end, I don't know, in the summer, in the spring, who knows, depending on what fiscal year your company has chosen. And but then you also have calendar year. So it is very confusing sometimes because folks starting a new fiscal year and then they like, whoa, but my deductions won't change until 1/1 for calendar year because benefit and payroll run on calendar year. So keep that in mind. This is open enrollment season. As we close out the year, we're ramping up for the new year and trying to get all that information together for the new year. Again, just sidebar call out. Go ahead and make sure if you don't have a communication from your company, reach out to your HR department. Believe me, they sent something out already, or they're about to. Go ahead and make sure you know about your open enrollment so that you may pick your voluntary deductions that come out of your paycheck.
Great call out. Not to continue the sidebar, but I do have a question for you on that. Right? So with some of those open enrollment periods that the employees are required to go in and select or elect or reconfirm those deductions, I've seen it where some companies have said, okay, the employee didn't do anything. They just kept the deductions that they had and it automatically enrolled them. I've seen other companies say you didn't complete it, your benefits stop.
Yep, that's the difference between active and passive.
Yeah,
because passive will automatically just renew whatever you had this year for the next year.
Okay.
Yeah. That's a great example. That's exactly right. You may lose your deductions if you don't go actively. And again, nothing changes. Everything could be the same, but they want you to actively go in and resubmit and confirm. This is usually best practice. It comes down to that. So yeah, just keep an eye out for your open enrollment if the benefits are important to you.
Okay.
Yeah. And speaking of the deductions, a great call out is that some of these amounts, some of the things that come out of our check are based on a flat number, $100 every time you get paid. Other things, as far as especially voluntary deductions, a 401k could be percentage, and that's 10% or 5% that's coming out of your pay every time you get paid. So just keep that in mind as you trying to figure out your check. Some numbers are number every time. Some numbers will fluctuate. A percentage will fluctuate based on your hours and earnings.
Yeah, that's a great call out, man. Like even with the involuntary deductions, it's the same logic, right? Same thing. Like you had a different type of garnishments.
So, that's true. Some of them are percentage. Yeah.
Yeah. So you can have they'll say, hey, 25%, up to 25%. I've seen it even with child support. I've seen child support come and they say, hey, up to 25% of the person's disposable earnings, or they just calculate a flat amount for them to pay on whatever their pay frequency is,
But you said a key word there: disposable earnings.
Yes.
What does disposable earnings mean?
That means after basically what we're talking about now, after the deductions. So they take your earnings and they take all the deductions out that they can, and then they say, okay, hey, what does this person have left over to the net pay? Basically, look at it and say, hey, all this money, we want to take 25% of it for this garnishment, for your child support, whatever. That's basically what it is.
And payroll folks, don't get worried, because usually the garnishment gives you the disposable calculation, because they all have someone different based on what they allow to be disposable. Basically, it's your taxes. They may say federal, and then the variances. Some states will allow you to include your medical benefits. Some states don't care. They're just like, nope, it's gross minus your federal mandate taxes.
Yeah.
And then that is your disposable. Whatever that number equals, that's your disposable income, not factoring in anything else. So just, best thing is try not to be in a situation where you're getting garnished, because it's going to hurt your paycheck. But as an employee, stay away. Try to stay out of garnishment situations. Pay it yourself a lot of times. And I'm sure we can do a garnishment episode is what I'm thinking. And maybe we cover, hey, let's talk a little bit about it now.
Yeah.
On garnishments, sometimes you'll get a warning. And right, and you get a warning,
notification letter.
Yes. Hey, pay this, or we're gonna come get it out of your check. Folks, pay it, because they're not playing. It comes out your check. And once it gets to payroll, the company is obligated, is required, is mandated to process that garnishment.
So I want to jump in here real quick.
Yeah, of course.
So something that I've practiced, and I want you to tell me whether you agree with it or not, right?
Sure.
So maybe something I could learn from. I developed this practice for myself that if I got a garnishment in for someone, I would still set it up in ADP. I would still do my job, but I would let the employee know, because I've seen in certain situations where the employee could reach out to that creditor and say, hey, I'll stop it. I'll pay, I'll pay $50 a month. So you don't have to worry about that and all those court fees and stuff or whatever. So let's just do that. And I just started doing that practice. So employees, like, I feel like we should give that service as payroll professionals.
Yes,
I know this series is about the employee, but I feel like as payroll professionals, we should give that employee or those employees those services.
Yes, we should. To the professional, I totally 100% agree. It's great customer service to get that garnishment and then go ahead and warn the employee, like, hey. And what I usually do, to your point, because we've probably developed this best practice together over the years, that I let them know when the last moment is to let me know what they did, so before it hits their paycheck. So I'll give them like a kind of a drop dead date, like, all right, if you let me know by 2:00 on this day, I can stop it still. But if not, it's going in your paycheck. And more often than not, folks appreciate that, and they have gotten back to me plenty of times. Hey, I talked to them, it's good. They're gonna send you. Oh, but the thing is, you can't take their word for it. You need a document from the agency.
Yes.
Stopping the garnishment.
Yeah, and they will provide that.
Absolutely.
They will send that.
Absolutely. Now, but it's timing sometimes, and you got to tell your employee, you got to set expectations. You got to say, hey, if I don't get it by this moment, you're gonna get hit with one. And then if they send me the thing that if it's done, then I'll ask them what to do with that. Because do I refund it to you, or do I let it go to them? And then you guys deal with that offset, because then it's less that you owe.
Yeah. So, now most agencies will tell you in that letter, though.
Yes.
They will say, hey, refund or
if they whatever. Okay, there you go. There you go. Yeah, no, it's definitely worth calling out, and it's definitely a good practice, because as an employee, from the employee perspective, this is hopefully you have a payroll department like us. You know what I mean? Yeah. But if not, you may get hit in your check, and you're like, oh man. But please believe there's probably been some type of attempted communication before that happened. Yeah. Before it hit your check, there was probably some attempt. So again, that's not the payroll department's fault. Payroll, once they get those garnishments, they have to legally abide by them. They are obliged to do it. So folks, don't get mad at your boy in payroll or your girl in payroll because they did that to you.
Your person in payroll.
Your person in payroll. Thank you, sir. And because they have to, man. It's their job, folks. It's their job. And that's a lot of the times people don't.
The Use Case Podcast is where technology vendors get to talk about themselves. And it's a wonderful place for vendors, investors, and practitioners to listen to the story of the solution, the features, the benefits, the attributes, etc. And we get to know the CEO or founder during the call, and we also get to know the tech. So subscribe to the Use Case Podcast.
Realize that. So as an employee dealing with your pay stub, yes, it's in your pay stub, but that error most likely originated somewhere else. and you got to find the root. Payroll will help you get to that root of the problem. Hey, I see this wrong. Who do I ask? And they can definitely tell you, because we're used to that. We're used to being like a air traffic controller. Questions come in and we got to send them to the right parties. Depending on how your organization is built, we'll get you to the right place, or it's our teammate and we're like, hey, hold on, we'll get you the answer. So just keep that in mind as you're looking at your deductions, whether they be involuntary or voluntary. If there are errors there, just be gentle as you reach out and to get the answer. And if you're starting with payroll, be gentle. Give it more bees with honey. Especially when you start the inquiry, because you don't want to get mad at the first person you talk to, and then they're like, okay, click. Now you're really gonna suffer and work hard to get this answer. Whereas you can just, hey, change your approach. I'm so sorry to bother you. This may not be you. And I get that a lot. Hey, you may not be the right person, but if you can help me understand, who do I ask, or what's going on with my check? I love answering those, because they're being respectful of us and have some understanding. Like, yeah, this is probably not your fault, but it's an error and I need to know what happened.
I can understand where you're coming from with that.
Yeah. Another call out are negative deductions, and we will repeat this throughout the deduction conversation. Because any deduction can be a negative deduction. Now, I know you're trying to say Ryan's double talking, because it's a deduction is already negating my money. What are you talking about negative deduction? A negative deduction is really a refund back to you. It's a clean way. Sometimes in the example that we just covered for the garnishment, that maybe it was an error. We got give it back. How do you give that money back? The right way, the best practice in any transaction on an employee's pay stub is to reverse it with the same code that it was used to deliver it, right? Keep that in mind, folks. For payroll professionals, this is probably one of the biggest call outs you could ever understand is if you're paying an earning and you have to reverse it, you got to use the same code that you did when you paid the earning. If you took out a medical deduction erroneously and you have to give that back, you have to use that same code to give it back. One, it's gonna trigger the taxability. When we get into pre-tax, we'll talk about the taxability pieces. So you want the system to understand that. And two, it's reporting. You want accurate reporting at the end of the year, because everything on a pay stub is going to impact your W-2. So you want that reporting to be proper. You need that refund to come out the way it went in. So
as the employee, that's something you want to double check, right? So I know that we're saying a lot of stuff that sounds like from the payroll perspective, but as the employee, you want to make sure that your payroll department does that. So if you notice a deduction for medical and they over deducted you, and you see a credit on your next stub but it says regular, that's something should be wrong with that. You know what I'm saying? So that's something to check out.
And a lot of times what they do, like phone allowances is the best. I don't want to start saying other ones because there's taxability issues. Phone allowances are usually paid as a negative deduction, because it's not an earning. You did not earn it. It's a gift from an allowance really from the employer, and the employer, us as employees, we don't pay taxes on it. And the employer also gets to write it off as an expense. It's a business expense. It's a legitimate business expense. It should not be taxed to the employee.
Yeah, and that's something that we'll get along. This is one of the other parts, a preview of one of the other parts coming up is post-tax deductions.
Correct.
So we'll be talking on that in a little bit as well.
If you can you have mentioned that we're going to do 4-part on deductions. Can you tell us what all 4 parts are going to be?
Yes. Part 1 we're discussing right now, voluntary and involuntary deductions. Part 2 is pre-tax deductions.
Part 2 is pre-tax.
Part 4, we focus on the taxes.
What happened to part 3?
Oh, that's a part.
You went 2 to 4, I think.
Oh, part 3. Part 3, we focus on taxes.
Okay, and then part 4?
Part 4 is post-tax deductions.
Gotcha.
So we structured it how the deductions will actually work in payroll. So your pre-tax deductions will come out first, and then your taxes, and then your post-tax deductions. That's how we structured the episodes as well.
Thank you very much, sir. And then it makes me think about, and I wonder where we put this, because I feel like it's more of a payroll thing, but it also, it's both. It's always both. There is a hierarchy of in a payroll calculation system, there's a hierarchy of what it's going to calculate out of your check first, and then second, and then third, and then because it goes for those federal deductions first. Yeah. It's not going to take out, for instance, if you don't have enough money to cover all your deductions in a pay period, let's say for some reason you don't have total out, you don't have a full paycheck for whatever reason, you know what I mean? And you're not making enough and you don't have enough to cover all of your deductions, it's going to take the taxes first. And then it's going to see if it has enough for your voluntary. Involuntaries will come out first.
Yes. Good.
And then it's so that's another thing to look out for. If you're like, okay, wait, I didn't have enough money to cover everything. Believe me, the company's going to circle back to you at some point and be like, hey, you didn't make enough for your medical benefits that week. You owe us still. We're going to have to take it out of your next check. And then look, if you're talking to your company, there are probably opportunities to work. So just be mindful of that. If you're an hourly employee and you got a lot of deductions coming out, right? You're getting all your medical benefits on the checks that you don't hit total hours, your full-time hours. Just be wary of that and mindful, because not everything you cover may have been able to come out of that paycheck. Yeah.
Good call out, man.
Yeah, man.
Call outs.
Yeah.
So let me ask you some questions then as we get closer to wrapping this up.
Sure.
For involuntary deductions, what power do I have as an employee?
Involuntary? Oh, man, that's a good one. Probably just education. As you prepared very well for us here, there's state by state is different type of rules. For example, Texas doesn't allow garnishments, only allows certain garnishments, right?
Yeah.
You can empower yourself with education on understanding what involuntary, where you can flex on your taxes, of course. Understanding your taxes, that's a whole nother deal. But at the end of the day, it becomes how much knowledge is power. So on the involuntary deduction side, knowledge is power. On the voluntary deduction, right, we control it out, all of it. I did want to cover something. You made me think about, see something here that we missed. On the medical benefit side, if you're paid bi-weekly, you know where I'm going. Sometimes your company will only take out 24 deduction amounts. So let me back up. If you're bi-weekly, you're going to get paid 26 times a year, because there are 2 months every year that you will get paid 3 times. Because the bi-weekly cycle and the month is long, you end up getting paid 3 times in 1 month, right? It gets extra money, but it's not. We've already calculated that. You're not getting paid extra. I used to love how when I was ignorant of it, I'd be like, oh man, I'm getting another check. Oh, this is amazing. No, your company already did the math. You're getting paid properly. But what they will do sometimes is they'll only take the medical benefits out of the first 2 checks of every month, and they'll give you a bit of a grace in that third check those 2 times a year, right? But it gets confusing, because then folks are like, oh wait, oh my god, you get a lot of calls, you didn't take out my medical. No, this is 3 times, we only take it out 24 times.
Hey, we're the payroll baddies, and our mission is to make payroll fun and relatable,
and call out industry when we hear it.
You gotta call it out. You gotta call it like you see it. But we also gotta shine a light on all those unsung payroll heroes out there, making sure we get paid.
Yeah, those are the real payroll baddies out there, and we love sharing their stories and showing them love.
With gold chain and everything, baby.
By the way, SAP is the best payroll out there, and if you don't like it,
get out.
Honestly, it's to the employee's benefit that you take it out 26 times, because then the amount is a little smaller. You can do both. I prefer the 26 times because, again, it's just a little bit more customer service, I think, customer friendly for the lower amounts. But keep that in mind. If you're bi-weekly and you're doing medical benefits, that 3 times a month, just think about it next time. Oh, wait, are they taking it out this 3 times or no? So if you see it that it doesn't come out, then you're probably set up for the 24 times a year as opposed to every paycheck. Just a call out. Yeah.
Nice. Thank you, man. That's a great call outs, bro.
Yeah, absolutely.
Yeah. Another question for the voluntary deductions. Can an employee stop those deductions at any time, or are there some rules around that?
So they are, That's a really great question. So medical side, it usually has to be a life. If you have if you have medical, dental, vision, dental and vision are usually a little bit more flexible, but medical for sure has to be a life event. Meaning, if you have family, now you can't just go all of a sudden say, I don't want family in the middle of the year, because you've already been priced out that way. And unfortunately, unless there's a life event, so let's be positive here. So if you were single, you're single or married, and you started off with a single plan, the only way you can add family on in the middle of the year is if you literally have a baby, if you have a new family member. You adopt, I'm sure adoption is considered, your family grows in a proper way, then you can add that family to your medical. So for medical, even though it's voluntary and all that, but you lock in for the year unless there's a life event. And losing your job and hardship are life events. So those can qualify sometimes. If your spouse loses their job, that's also a life event that could help you out. That's a qualified life event. But they have to be married unless your company allows for domestic partnership. Not every company does. So those are, we have choices, but they're a little bit limited. Even when it comes to 401k, the plan documents will dictate when you can go in and out of the plan and how often you can change your elections.
Okay.
So even though you may be able to change it and cut it off and on, for instance, some companies allow for the first of every month you can make a change if you want to come in and out of the plan. Meaning, I want 5% now. I'm a little tight next month. I'm going to do 0% next month. But they'll allow it only at the first of the month. Some companies only allow it quarterly. So if you contribute to 401k, be mindful of the rules of how you can go in and out of the plan.
Roger that. Thank you for those.
Yeah, absolutely.
Yeah, and I guess one more last question. When it comes to documentation and voluntary deductions, there will always be some document trail showing that the employee signed or agreed to the deduction or electing a deduction. There always needs to be that backup.
Yes, absolutely. Everything that happens in your check should have some documentation to back it up. That's a good area. We should talk about all that at some point. Is like, because earnings should be based on your offer letter or your hiring documents. Your deductions, your taxes should be based on your W-4, and everything else should be based on something that you elected. And there's documentation for it, because if not, you need to look at your check, understand the codes that it's happening, understand what's going in and out of your check. And I think we spoke about this before already, is understanding what those codes. I've had folks that it's not until they go file taxes that they realize, oh wow, I've been paying the wrong thing all year. I had somebody, and this goes to show you folks, look at your check. I had somebody that lived in one state but was paying state taxes to another state across the country for the whole year.
Yep.
Now, granted, that's a setup error. There's some onus on the company for the footfall, dropping the ball there. But like I say in this all the time, some of this is on us to validate our information. So that means that person wasn't looking at their pay stub all year long. They did not look at their pay stub all year until they went and filed taxes. And then they see, because a lot of people, I don't know if they can still do this, but a lot of folks file off their last pay stub because they can't wait for their W-2. They're gonna go file taxes off their last pay stub. And that's dangerous, folks. That's another thing. Gosh, we're dropping gems today. That is another thing. Do not file off your last pay stub, folks. If you're in dire need, there's a chance that the information can change from your last pay stub to your W-2, because we as payroll professionals have a grace period between your last pay stub and when those W-2s get issued to do any final add-ons or deletions or adjustments to the transactions for the year for you. Okay. And some companies have year-end add-ons. Sometimes you'll get a phone. If a company gives you a phone, a lot of times the agreement is, hey, we're gonna give you the phone, but we're gonna add the cost of that phone onto your earnings at the end of the year. Yeah, well, you're getting $1,000 phone right now, but you're going to pay the taxes on it because we're going to add that onto your earnings at the end of the year. So guess what? You may be $1,000 off from last pay stub to your W-2.
Yep.
So please try not to file off of your last pay stub. The numbers can absolutely change within legal limits.
Yes, that's a great nugget.
Yep.
We'll have to definitely bring that nugget up when we talk about taxes and W-2s.
Exactly.
Again. So yeah, I think that's a good way to cap it off, man.
Awesome, man. Thanks for joining us again, folks. As always, we're here to help. Hopefully, you got a couple of gems today. And catch us next week. We're gonna continue this 4-part series of deductions, and we'll be on part 2 of it.
Yep. Looking forward to it. Take care, guys.
Take care.
All right. Bye. Thank you for listening to today's episode of our podcast. We appreciate you. We're grateful for you. And we hope that the information that was shared with you will impact you as a payroll professional. Until next time, keep learning, keep growing, and most importantly, keep going.